For the last couple of years in Australia, it's been quite challenging for some of us to access finance and to get money. Now, that has had a huge knock-on effect throughout the Australian economy, and particularly the Sydney and the Melbourne property markets, where a few years ago things were going very well, and now today things have been negative. So in this video, I'm going to talk about, is it harder to get finance, and what can you expect in Australia over the next couple of years? The very first thing I wanted to touch on in today's video is the real estate cycle. So generally the real estate cycle looks like this. It goes up, it hits a flat spot, it goes up, and then it comes down, and then we start again. Now, money at different stages of the real estate cycle comes in waves. Now, when we come out of a GFC, this is sort of a GFC style event, think 2009 type thing. What happens is the entire world's banking system, a lot of property prices around the world, a lot of governments' balance sheets, as well as a lot of the banks' balance sheets look quite negative. And so to re-stimulate the economy, we go through this period which is above the line, and this is just easy money. Now, this is when governments, banks, and effectively everybody in the finance world just sprays money into the economy. They call it pump priming, to keep things ticking over and to get things started again. Then we come into this phase that we're kind of in at the moment, which is called the mid-cycle slowdown phase, where everybody realizes that all of that really cheap money that's been injected into businesses, into the stock market, and into the property market has made everything really effing expensive. Now, we go through this period, which I can call hard money, where it becomes more and more difficult. Banks get more selective about who they're taking on board, because at this stage of the cycle, asset prices, stocks, and property prices can actually go flat or go down in certain markets for a period of time. Then we get to another phase of the cycle, which is easy money again, and that is the second half of the real estate cycle, which we should be moving into from about late 2020 into 2021, and then we get this decline. Think about the GFC, think about the recession we had to have in the 90s, think about the Great Depression, where it's really hard to access money, and only people in the best possible positions can actually continue to get it. Now, if you understand this and how this lending policy around the world or in Australia actually affects your ability to get finance at certain times in the cycle, then you will understand where we are right now. And like I said, we're sort of sitting here right now, which is hard money time. Now, in Australia, it started a little bit earlier than some other countries around the world. London's also been in some hard money times for a while, but in terms of this hard money in Australia, it's just one of those times where some investors get caught out. Now, if you're in a strong financial position with good equity in a property, with a good job and with good cash flow, or you're just starting out in your investment journey, then the last couple of years have been a breeze. You've been able to continue to borrow money and continue to get on with investing or your business or whatever it is that you want to do. But for some other people, it's been a really difficult couple of years. Now, the first range of changes or round of changes in Australia came in 2015, and they've been progressively getting worse as a result of APRA over the last couple of years, to the point where some people that are over leveraged, that are carrying too much debt, or that look a little bit risky to the banks, have found it very difficult over the last couple of years. Now, according to my broker, who's been in the industry for the last 15 years, Aaron, in November 2018, things for the very first time in a couple of years started to look like they were softening up. It looks like, because these things take time, it doesn't just take time for banks to change their policy, but it takes time for that sentiment and that awareness to get out, first through the mortgage broking and banking community, and then second out to the general public and the early adapters like me who want to take advantage of those conditions, and then through everybody else in the marketplace that comes in waves. So, things are slowly starting to loosen up. I'm not saying that things are going to change in a big way in 2019, but some of those handbrakes or some of those speed bumps that we hit in 17 and 18 around finance are slowly starting to be lifted, particularly for investors. And that means we move through this period which will look like historically 2017 through to about the end of 2019, maybe as far as late 2020. And then I can guarantee you 18 months from now, money will be starting to move around the economy again. Things will start becoming a little bit easier, and then we'll be off to what Phil Anderson and Fred Harrison call the second half of the real estate cycle, where people get on with the business of setting up their lives before we come to probably one of the biggest crashes that we'll see in the last 100 years. So if you want to know more about that stuff, check out my video titled The 18-Year Real Estate Cycle Explained, which is just an overview of Fred's work and Phil's work. Again, this is sort of a 7 to 10 year cycle here. This is another 7 to 10 year cycle. Ray Dalio, the most successful hedge fund manager of all time, wrote a great book on these 7 to 10 year cycles and what to do and how to understand them better, called Principles. But I do believe that money is getting a little bit easier, and I think progressively over the next 6 to 12 months, once all this Royal Banking Commission stuff dies down and we start focusing on the next thing, and people realise that, you know, prices in Sydney and Melbourne this year will probably continue to decline, but a couple of years from now things will start turning around again. You know, it helps you understand that broader cycle based on money, because anybody that understands the cycle understands that it hasn't been driven this time, the price drops in Sydney and Melbourne, by interest rate rises. It hasn't been through high unemployment rates. It hasn't been through a major recession cycle globally. It's purely been the regulatory body APRA, which has come in and said enough's enough. If we don't slow things down and make it a bit harder for certain parts of the market to access finance and start lending a bit more responsibly, then we're going to have a huge bubble in Australia, and that's going to be a huge long-term issue for us. So lending's getting easier. Don't buy the hype. It doesn't actually affect most investors. In fact, about 80% of the market can probably still put themselves in a really solid position, or is already in a really solid position to consider buying. It's just more those people that are a little bit over leveraged or with really, really low incomes and high expenses in their lives that are suffering at the moment. But don't you worry, money is going to get easier again, and we'll be off to the second half of the real estate cycle and the races again. Cheers guys, enjoy your day, good luck investing.